...2022 was arguably the worst year for bonds, going all the way back to the beginning of the index, which started in 1976. Take a look at this chart. Each of these bars represents the return for 1 year for the bond market. Most of them are above the line, and there's really only been 5 negative years going back to 1976, and most of those were down just 1% or 2%. If we look all the way to the far right, 2022 really stands out as an outlier as core U.S. bonds fell 13%. What's interesting though, many people have attributed the very bad year for bonds last year to the Federal Reserve's aggressive rate increases. Those increases continued in the fourth quarter of last year, and yet bonds, unlike the first 3 quarters, were positive. Bonds were up 1.9% in Q4. Why is that? Why, even though the Federal Reserve raised rates another 1.25% in the fourth quarter, were bonds positive? And for us to understand that, we need to look at something called the yield curve. Take a look at this chart, and this is a yield curve for U.S. Treasury bonds. And a yield curve simply plots the different yields for bonds of different maturities. And so for the far left, you have short-term bonds of 1 and 3 and 6 month maturities. And you can see their yields going up. And then on the far right are longer-term bonds, so 10 and 20 and 30 years on the far right, and the yields that are available for those bonds. What we know about the Federal Reserve interest rate hikes is they're actually hiking very, very short-term rates. It's called the federal funds rate, and this is the rate that banks charge each other to lend money from one bank to another overnight. So it's a single one-day maturity bond. And so when the Fed raises rates, it really impacts short-term bonds. It doesn't directly impact longer maturity bonds in the same way. And so take a look at this second chart. And on this chart, we still have the 9/30 yield curve. We also have the end of the fourth quarter yield curve now in red. And you can see on the left-hand side, the red curve is well above the blue curve. So the Fed's interest rate hike had a big impact on these short-term bonds, but in the intermediate and long-term bonds, there's really not much difference. And so the reason that matters is for the index and for bond investors who invested similarly to the index, most of the impact from bond interest rate changes comes in intermediate and longer term bonds. They're much more sensitive to rate changes. And so in this case, in the fourth quarter, even though short-term bonds went up significantly, intermediate and long-term bonds did not. And that's why, despite the Fed raising rates quite significantly in the fourth quarter, it was still a good quarter for the bond market. Now, what does that mean for investors from here? Well, even though the Fed is expected to continue to raise rates, there's a pretty good chance that that may not be the bad news for bond investors that many expect. It could be much like the fourth quarter of last year, where intermediate and longer term rates don't move. And now, because of the higher yields available to bonds, it creates a great opportunity for investors who can now buy bonds yielding much more than they could have even just a year ago.